Jan Lee will present the final paper on our session.
Hi, I'm delighted to be here to present the findings from the FDIC Small Business Lending Survey. So this has been discussed earlier today in the presentations. Small businesses are very important to the U.S. economy. They make up about 48% of private sector employment and 65% of new private sector jobs. And banks are the most common source of external credit for these small businesses. Now, people tend to think through conventional wisdom and also through previous research that small and large banks tend to do things differently. So small banks, people tend to think of as the relationship lenders. They use soft information. They have repeated interactions with borrowers in the community. Whereas large banks, people think of as the transactional lenders. They typically look at quantifiable, hard information to process their loan decisions. And so they're thought of as the transactional lenders. And as mentioned earlier, people think that distance is important for both the bank and the borrower. So distance is important for small business lending. So why would we have this survey? Now, as also mentioned before, there's been some trends in the past 10 years. So for example, the number of small banks have dropped by about 1/3 in the past 10 years, and the number of overall bank branches have decreased by 10%. So what are the implications for small businesses? And in order to provide the right context for that, we first have to say something about how do banks actually conduct their small business lending? What can we say about that? And do small and large banks actually do things differently? So this is where the FDIC Small Business Lending Survey steps in. So this is a nationally representative survey of banks. These are FDIC insured institutions and how they conduct their small business lending. The survey was conducted in the second half of 2016 and the early part of 2017. And up until this point, there's been relatively few surveys of bank small business lending practices. Typically, they're convenience surveys, meaning whoever can answers, and that's very valuable information, but it's not nationally representative. And they're typically only of small banks, so you can't make a comparison between small and large banks and what they do. And also, typically, there are fewer topics. So the SBLS is different in the sense that it's nationally representative, so we can take the answers and weight it in such a way that we can say something about the entire industry, and we can say something about what small banks do and what large banks do, and whether there's a difference. So these are some of the topics covered by the SBLS. Today's presentation will cover some main conclusions from the first 4 topics. So for example, how do banks describe or characterize their small business borrowers? What are banks' market areas? And what are their competitive environments for small business lending? And also we'll talk about competitive advantages and practices used by both small and large banks. And we'll also look at the loan products and underwriting that small and large banks use to lend to small business, including startups. And we won't talk about this today, but the survey also asked banks about their total volume of originations and and the size of the borrower and the collateral. So we did that in order to assess whether current reporting of small business lending is understated. And we won't discuss this today, but we find that for small banks, that at least 29% of their small business lending was understated in 2015. So that's very substantial. So just to give an idea of the quality and coverage of the SBLS, so in our report, we define small banks as those that are 10 billion or less in assets, and large banks that are those that are 10 billion or more. And in 2015, when we drew the sample, there were about 6,000 FDIC insured institutions. And from there, we sampled 2,000 banks, meaning we asked 2,000 banks to respond to the survey. And of those 2,000, 1,200 responded with an overall response rate of 60%. So that's very high, and it's high for both the small banks and large banks. So we can say something definitive about the industry with these response rates. So now turning to some of our main conclusions, and today is just a subset of some of our findings, but these are basically the broad statements that we are comfortable making with the results of the survey. So one thing we find is that indeed small banks are relationship lenders. We asked banks, hey, what are your practices that you use to generate and maintain small business relationships? And what are your top 3? And we find that the ones that float to the top, you see customer referrals, ability to talk to someone, community involvement, those are what we call high touch. That means you really have to use staff-intensive, people-to-people interactions. In contrast, only about half of 1% use online applications as a way to interact with small businesses. So you see that for small banks, they really concentrate on the relationship aspect. And these orange bars are the percentage of small banks that say that they use this particular practice. Now, we also ask banks, hey, how would you describe your small business borrower? And this is an open-ended question. You can say whatever you want. And we took their answers and we categorized them into these buckets. And we see for the orange bars, those are the shares of small banks and their answers that we grouped into these categories. They use a variety of different ways to describe their small business borrowers. Now, in contrast, the blue bars are the large banks. So you see that the large banks typically only use quantifiable metrics, and they were able to say whatever they wanted, but they focused on revenue or sales, loan size, or aggregate loan exposure, which are very quantifiable metrics. Now, small banks are also considered top competitors by both small and large banks. So we ask banks, hey, who are your competitors? Who are your frequent competitors for small business lending? And then we ask them, hey, who are your top 3 competitors for small business lending? And you see on this left-hand side, the ones that float to the top are local banks. And when I say local, I mean that this is a local bank in your physical market, and that's how we define local in the survey. So a bank that's actually in your market. And we find that 2/3 of both small and large banks say that a small bank with assets of 1 to 10 billion is one of their top 3 competitors. So 2/3 of both small and large banks consider a larger small bank as a top 3 competitor. Now, of these top 3 competitors, we ask, okay, hey, who is your number 1 competitor for small business lending? And so we see here, above the red line are those banks that consider a small bank as their number 1 competitor, and below the red line are those banks that consider a large bank as a number 1 competitor. And what you can see here is that if you add up these 2 orange bars, about 75% of small banks think another small bank is their number 1 competitor. And then about another 13% say a large bank is the number 1 competitor. But what we want to notice here is that large banks, 65% of them say another large bank in their local area is their top competitor. But about 20% say a small bank of 1 to 10 billion is their number 1 competitor for small business lending. So 2/5 of both small banks and 1/5 of both small banks and 1/5 of large banks think a small bank of $1 to $10 billion is their number 1 competitor for small business lending. In comparison, these are some of the other options that the banks were given for their top 3 or number 1 competitor, and they don't choose a local non-bank, either top 3 or number 1. And they also don't choose non-bank lenders, for example, credit unions or fintech. So about 1/3 of small banks say that credit union is a top 3 competitor, but less than 5% say it's a number 1 competitor. So the big takeaway here is that local banks are important for small business lending competition, and small banks tend to be more of a competitor than vice versa for small business lending in particular. Okay. So lastly, for small banks, they're perceived as relational, attentive, fast. And this graph is a little bit different from others in the sense that the orange bars are what the number 1 competitors for these small banks say about small banks, and the blue bars represent all the banks that say a large bank is their number 1 competitor. And we see that the competitors for small banks say that they're good at customer service, that's established relationships, that's quality staff, and they also get speed of service. So speed of service is very important for small businesses, one of their reasons for dissatisfaction in the loan application process, according to surveys of firms. Okay, so large banks are seen as the transactional lenders that are with advantages in convenience and pricing. I'll go through that relatively more quickly. So this table is a summary of a bunch of different questions, and we find that, as expected, large banks are much more likely to use transactional processes. For example, do you define a small business using either aggregate loan exposure or gross annual revenue? And 85% of large banks do, compared to only about 28% of small banks. And in their underwriting, do you have like a floor for your loan amount? For example, does the loan have to be of a certain size? So 70% of large banks say, yes, it has to be a certain size, compared to only 15% of small banks. And then do you evaluate business credit score? So large banks are several magnitudes more likely to evaluate a business credit score. And in terms of standardized products, large banks are much more likely to offer credit cards, and they're much more likely to offer standardized small business products. So for example, like an express loan. So you see that large banks are much more likely to use these transactional practices. And in terms of how they describe their small business borrowers, they had a much more narrow set of things that they looked at. And similarly with startups, the vast majority of large banks will tend to evaluate startups differently. So over 90% evaluate them differently, and they tend to only look for one thing, a guarantee. 80% of them want a guarantee, in particular an SBA guarantee, whereas you see small banks look at a variety of different things when they talk to startups. Okay. And then in terms of how they're perceived, so again, these bars are a little bit different. The blue bars are what the top, or are the competitors who have a large bank as their top competitor, what do they think about large banks? And they're perceived to be more advantaged in convenience and pricing. Okay. So turning to the overall industry, one of our more stark findings is that there's really a core set of characteristics for small business lending in general, for both small and large banks. There's a lot of commonality. Small business lending is local, and this reinforces what we saw earlier in terms of who are the top competitors, which are local banks. In the same way, when we ask banks, hey, where can you allow your small business to apply for a loan, 95% of both small and large banks say you apply at the branch level. Some of them say we do it through telephones, which is still high touch, you're really talking to someone. Some of them say, hey, we can visit your business, which is still very, very local. Very, very few use online options, and that's both for small and large banks. While large banks might do it more, it's still a very small share compared to the local, more high-touch options. And then when we asked banks, hey, what are your own competitive advantages? Earlier we showed, hey, what do you think are the competitive advantages of your top competitor? Here we're asking them, what are your own? And we see for both small and large banks, the ones that float to the top are the customer service ones. Established relationship, personal attention, staff quality, that's what we had under customer service. That's important for both small and large banks. This is what they think they need to do to conduct their small business lending well. And lastly, I'll just end with some of the practices that banks do. Previously, I talked about competitive advantages. That's what you think you're good at, but these are actual practices, what you think you do. So each dot here represents a certain practice. And so the y-axis is the percentage of small banks that use this practice, and the x-axis is the percentage of large banks. So anytime you see a dot on the red line, that means both small and large banks use it equally. And you see that these dots tend to move together. So the ones up here, that means both small and large banks use them. And the ones down here, that means, hey, neither uses them very much. And you see that some of the dots are more to the right of the red line, the 45-degree line. That means large banks tend to use them a little bit more. Okay? And so what are some of these practices? And we can organize them into different categories. And you see that these ones on top, these are the personal interactions, as opposed to, say, business services, which are at the bottom. And some of these, for example, external sources, some of them are at the top and some of them are at the bottom. And you could ask, okay, so what are these particular practices? And we find that ability to talk to someone, that's the most important. Walk-ins. And in terms of the external sources, the ones that are most important are referrals. That means you talk to someone, you talk to your customers, you talk to your professional network, and that's how you generate and maintain relationships. And what you see is that ones on the bottom, so large banks tend to emphasize convenience, but those are hours open and branch network. That's still talking to your customers. It's not online applications. So the big takeaway here is, hey, everyone has to use basically high-touch, staff-intensive practices in order to engage their small business customers. So overall, we find today that small and large banks have very unique and distinct advantages, some that we expect, but that overall, for small business lending by banks, they need to be in touch with their customers. They need to be in touch with their networks. They need to have a lot of face-to-face interaction. And that's very, very important for small business lending. And these are the answers that the banks themselves gave for how they conduct their lending and what they think is important. And bringing it back to the original context, which is consolidation, there's fewer small banks, and that might have a negative consequence for small businesses if they really find that interacting with a relationship lender is important for them. But overall, there's less branches, and branches is where the action is taking place, and that might also potentially have a negative consequence for small businesses.